Something is happening in the physical silver market that deserves your careful attention, not because of wild predictions, not because someone wants to sell you something, but because the patterns emerging now echo moments in history when the world's economic architecture fundamentally shifted. Central banks across Asia, the Middle East, and Latin America are diversifying their reserves. Trade agreements are being rewritten in currencies other than the dollar. Supply chains that took decades to build are being reconfigured in real time. And in the middle of all this, a strange phenomenon. Physical silver is becoming harder to source, even as most investors remain completely unaware of the larger forces at play. This is not about getting rich quickly. This is about understanding a transition that could define the next decade of your financial life. Today, we're going to examine what's actually happening in the silver market, why it matters in the context of a changing global order, and most importantly, what you should be thinking about as someone responsible for protecting and growing wealth in uncertain times. Let's begin with clarity, not panic, with analysis, not emotion, with the understanding that your best decisions will come from patience, not from fear. The term multipolar world sounds abstract, but its implications are concrete and far-reaching. For over 7 decades, global commerce operated under a relatively simple framework. The United States dollar served as the world's reserve currency. International trade settlements happened primarily in dollars. Nations held their reserves in U.S. Treasury securities. This system provided stability, but it also created dependencies. What happens when those dependencies begin to shift? We're witnessing the answer unfold in real time. China and Russia are settling trade in their own currencies. Saudi Arabia is entertaining oil sales in yuan. The BRICS nations, Brazil, Russia, India, China, and South Africa, are actively discussing alternatives to dollar-denominated trade. These aren't merely political statements. These are structural changes with financial consequences. When trade patterns shift, so do capital flows. When capital flows change, so do asset valuations. And when the global monetary architecture begins to reconfigure itself, certain assets move from the periphery to the center of strategic importance. Silver is one of those assets. Why silver? Why not just gold? Because silver occupies a unique position. It's both a monetary metal and an industrial commodity. It's too important for technology to ignore and too historically significant as money to dismiss. Let's examine the industrial demand first. Solar panels require silver. Every electric vehicle contains more silver than a traditional combustion engine. 5G infrastructure depends on silver's superior conductivity. Medical applications, from antimicrobial coatings to diagnostic equipment, rely on silver's unique properties. The transition to renewable energy alone creates a structural demand that didn't exist a generation ago. The International Energy Agency projects that solar capacity will need to triple by 2030 to meet climate goals. Each gigawatt of solar capacity requires approximately 40 tons of silver. Do the mathematics. That's not speculative demand, that's industrial necessity. Now layer on the monetary dimension. Throughout history, when confidence in paper currency systems wavers, people return to tangible assets, not because of superstition, because of experience. The Weimar Republic taught us what happens when currency loses credibility. The fall of the Roman denarius demonstrated it centuries before. More recently, Argentina, Venezuela, and Zimbabwe have provided modern case studies in monetary dysfunction. You don't have to believe the dollar will collapse to understand the logic of diversification. You simply need to recognize that no monetary system lasts forever, and transitions, when they happen, tend to be disruptive. The prudent question isn't whether change will occur. It's whether you're positioned to weather it when it does. Now let's talk about supply dynamics, because this is where the market becomes genuinely interesting. Silver mining is not like turning on a faucet. It takes years to bring a new mine online. The majority of silver, roughly 70%, comes as a byproduct of mining other metals, copper, lead, and zinc. What does that mean in practical terms? It means silver supply doesn't respond quickly to price signals. If copper demand declines, silver supply can fall even if silver prices are rising. The market doesn't behave rationally because supply isn't determined by silver economics alone. Global silver mine production has been essentially flat since 2016. Some years show marginal increases, others slight decreases, but there's no dramatic growth trajectory. Meanwhile, industrial applications continue to expand. This creates a structural deficit. The Silver Institute reports that industrial demand plus investment demand has exceeded mine supply in recent years, with the gap filled by above-ground inventories. Those inventories aren't infinite. The COMEX, the major exchange for silver futures in North America, publishes data on registered silver available for delivery. Observers have noted these levels fluctuating significantly, sometimes declining to levels that represent just a few days of global industrial demand. We must be careful not to draw conspiracy theories from data. Markets are complex. Storage shifts happen for mundane reasons. But the pattern is worth noting. Physical silver appears to be moving from visible inventories into private hands. Institutional buyers, sovereign wealth funds, and family offices don't announce their purchases. They operate quietly. By the time their strategies become public knowledge, the accumulation phase is often complete. Is this happening now with silver? The circumstantial evidence is compelling, though not definitive. What we know with certainty, premiums on physical silver, the markup dealers charge above the spot price, have been elevated for several years. When demand for physical metal exceeds readily available supply, premiums rise. That's basic economics. This matters because it reveals a divergence between paper silver and physical silver. The spot price reflects trading in futures contracts, which can be settled in cash. The premium reflects actual metal changing hands. When that spread widens persistently, it suggests something real is happening in the physical market, regardless of what futures traders are doing. Central banks have been accumulating gold at rates not seen in decades. This is documented, transparent, and widely reported. What receives less attention is the strategic thinking behind this accumulation. Central banks diversify reserves not because they're speculating. They do so because they're managing risk across generations. They're preparing for scenarios where current systems face stress. The Bank for International Settlements, the central bank for central banks, has published research on the stability properties of gold in reserve portfolios. The conclusion? Gold provides insurance against tail risk events that can devastate paper asset portfolios. Silver doesn't appear on central bank balance sheets the way gold does. The market is smaller, more volatile, and traditionally viewed as less suitable for official reserves. But that doesn't mean sophisticated institutions ignore it. Private wealth preservation vehicles, endowments, and family offices operate with different constraints than central banks. They can move into smaller markets. They can hold positions for decades. And they don't need to disclose their strategies. This is where silver becomes particularly interesting in a multipolar context. If you're a wealth manager in Singapore, Abu Dhabi, or Shanghai, and you're advising clients who want to diversify away from dollar-dependent assets, what are your options? Real estate in stable jurisdictions, productive businesses, energy infrastructure, and physical commodities that hold value regardless of which currency system prevails. Silver checks several boxes simultaneously. It's globally recognized. It's difficult to counterfeit. It's historically monetary. And it's industrially essential in technologies that define the future. You don't need a conspiracy. You just need logic and the long view. Let's discuss something that receives too little attention in financial media: the psychology of asset ownership during structural transitions. Most investors optimize for the current system. They hold what has worked. They follow strategies that succeeded in the last cycle. This is rational until the cycle changes. The challenge is that cycle changes don't announce themselves clearly. There's no headline that reads, "Old system ending, new system beginning." The transition is gradual, marked by anomalies that most people dismiss until the pattern becomes undeniable. We saw this with internet infrastructure in the late 1990s. The technology was real. The hype was excessive. Most investors either ignored it entirely or speculated recklessly. Few found the middle path of patient, strategic accumulation. We saw it with real estate before 2008. The leverage was unsustainable. The warning signs were visible. But dismissing concerns was easier than acting on them, right until it wasn't. We're seeing it now with the assumption that the dollar's dominance is permanent and that global trade architecture won't fundamentally change. Maybe that assumption is correct. Maybe the current system persists for another 50 years. But what if it doesn't? What if we're in the early innings of a transition that historians will mark as significant as Bretton Woods or the end of the gold standard? The cost of being wrong by ignoring the possibility is severe. The cost of being wrong by preparing for it is minimal. This is where silver enters the conversation, not as speculation, but as allocation. Analysis, understanding real hoarding versus strategic accumulation. The word hoarding carries negative connotations. It suggests irrationality, fear-driven behavior, perhaps even greed. But there's a difference between hoarding and strategic accumulation. Hoarding is reactive. Someone hears a rumor and rushes to buy, regardless of price, because they fear missing out. They have no framework, no discipline, no exit strategy. Strategic accumulation is different. It's systematic. It recognizes value when others are indifferent. It builds positions over time at prices that reflect genuine worth rather than panic premiums. What appears to be happening in the silver market is more strategic than emotional. The buyers aren't panicking. They're not leveraging themselves dangerously. They're simply recognizing that in a world where monetary policy has become overtly political and where geopolitical tensions reshape trade, physical commodities offer something paper assets cannot: independence from counterparty risk. Silver can't be printed. It can't be hacked. It doesn't depend on any government's good faith. It simply exists with properties that make it useful and scarce enough to hold value. This becomes increasingly relevant as digital currencies proliferate. Central bank digital currencies are coming. They offer governments unprecedented surveillance and control over economic activity. Some people will embrace this. Others will seek alternatives. Physical silver represents one of those alternatives, not as a replacement for the entire monetary system, but as a component of a diversified approach to preserving wealth outside purely digital mechanisms. If you already hold physical silver, you're facing a different set of questions than someone just considering an entry. Your first consideration: why did you buy in the first place? If you bought silver as insurance against monetary instability, has that thesis changed? If anything, the multipolar shift strengthens the case for holding tangible assets outside the financial system. If you bought for industrial demand growth, are those drivers still intact? The energy transition isn't reversing. Technology advancement continues. The industrial thesis remains sound. Your second consideration: position size. Holding 5% of your liquid net worth in silver is a hedge. Holding 50% is a speculation. Know which category you're in. If your silver position has grown to represent an uncomfortably large portion of your wealth, not because you bought more, but because other assets declined, consider rebalancing. Not because silver is wrong, but because concentration is risky regardless of the asset. Your third consideration: physical versus paper. If you hold silver through ETFs or futures contracts, understand what you actually own. These instruments track silver prices, but in a genuine crisis, the scenario that justifies holding silver, settlement in cash rather than metal, is possible. Physical silver in your possession or in allocated storage is different. It's yours. It can't be rehypothecated. It doesn't depend on anyone else's promises. This doesn't mean ETFs are wrong. They serve a purpose for traders and for people who want price exposure without storage concerns. But if your thesis is about systemic resilience, physical makes more sense. Your fourth consideration: patience. Silver is volatile. It will test your resolve. You'll watch it surge and wonder if you should sell. You'll watch it decline and question whether you made a mistake. Neither emotion should dictate your actions. If you bought silver as a long-term holding, then short-term price movements are noise. Focus on whether the underlying thesis, industrial demand, monetary transition, geopolitical shifts, remains valid. As long as those factors persist, your strategy hasn't changed. If you're considering silver for the first time, approach it with care and clear thinking. First, examine your motivation. Are you buying because someone on social media claims silver is about to explode? If so, stop. That's not a plan. That's gambling. Are you buying because you've studied the supply-demand fundamentals, understand the geopolitical context, and believe physical commodities deserve a place in a diversified portfolio? That's different. That's strategy. Second, understand what you're buying. Physical silver comes in various forms: government-minted coins, private mint rounds, and bars of different sizes. Each has different premiums and liquidity characteristics. Government coins like American Silver Eagles or Canadian Maple Leafs carry higher premiums, but are more easily recognized and traded. They're suitable for smaller purchases and for people who prioritize liquidity. Larger bars, 10 ounce, 100 ounce, or even 1,000 ounce, carry lower premiums per ounce but are less divisible. They're more efficient for larger positions, but less practical if you might need to sell small amounts. Choose based on your situation, not on what someone else is doing. Third, consider your entry strategy. Buying all at once exposes you to timing risk. If you purchase your entire position and the price drops 20% the following month, you'll feel foolish even if your long-term thesis is correct. Dollar cost averaging, buying fixed amounts at regular intervals, removes emotion from timing. You buy more when prices are low, less when they're high, and you avoid the psychological trap of trying to catch the bottom. Set a target allocation. Let's say you decide 8% of your portfolio should be in silver. Calculate that amount, then divide it into 12 equal purchases over a year. This approach isn't optimal for returns. If silver rises consistently, you'd have done better buying immediately. But it's optimal for sustainability. You can stick with it. You won't panic yourself out of the position because you didn't overcommit at a peak. Fourth, plan for storage. Silver is heavy and bulky. 100 ounces weighs over 6 pounds. 1,000 ounces is over 60 pounds. Home storage is simple and gives you immediate access, but it comes with security concerns. A safe deposit box at a bank is better than a closet, but it introduces dependence on banking hours and, in extreme scenarios, potential government restrictions. Private vaulting services, companies that store precious metals in allocated accounts, solve the security and bulk issues but introduce counterparty risk. You're trusting them to actually hold what they claim and to give it back when you want it. There's no perfect solution. Choose based on the amount you're holding and the risks that concern you most. Let's be direct about behaviors that destroy wealth in commodity markets. Mistake 1, leverage. Buying silver on margin or using futures contracts to amplify your position feels sophisticated. It's not. It's dangerous. Silver is volatile. A 30% drawdown is not unusual. If you're leveraged, that volatility can eliminate your position before your thesis has time to play out. Physical silver purchased with cash can't force you to sell at a loss. Leveraged silver can and will. If you can't afford to buy silver outright, don't buy it. Wait until you can. The opportunity cost of waiting is far lower than the catastrophic risk of leverage. Mistake 2, emotional trading. Silver will move dramatically in both directions. You'll see days where it jumps 8%. You'll see weeks where it drops 15%. If your response to a 15% rise is to immediately sell because you're afraid of giving back gains, you're not investing, you're gambling. If your response to a 15% decline is to panic and liquidate because you think it's going to zero, you're not investing, you're reacting. Establish your strategy before you buy. Write it down. What would have to change fundamentally for you to sell? Not price, not volatility, fundamental change. Refer to that document when emotions run high. Mistake 3, concentration without conviction. Some people accumulate large silver positions not because they've analyzed the market, but because someone they follow on YouTube is enthusiastic. You cannot sustain a meaningful position in a volatile asset based on someone else's conviction. When the inevitable drawdown comes, you'll sell at a loss because you don't actually understand why you own it. If you can't explain your investment thesis in 3 clear sentences, you shouldn't be making the investment. Mistake 4, ignoring opportunity cost. Money allocated to silver is money not in stocks, bonds, real estate, or businesses. All investments have opportunity costs. If you put 40% of your wealth into silver and the stock market doubles while silver moves sideways, you've paid an enormous opportunity cost, even if silver wasn't a bad investment on its own. Balance is not cowardice, it's wisdom. Mistake 5, confusing insurance with speculation. Insurance costs money. You pay premiums on your homeowner's policy hoping you never collect. The policy is successful if your house never burns down. If you view silver as monetary insurance, then stagnant prices don't mean failure. They mean you still have your insurance. The insurance is working by being there. If you view silver as a speculation meant to outperform everything else, you'll measure it against stocks, become frustrated with underperformance, and likely sell at the wrong time. Know which game you're playing before you start. Mistake 6, following the crowd late. By the time silver is headline news and everyone at your workplace is talking about it, you're not early, you're late. Accumulation happens in obscurity. By the time assets become consensus trades, the best entry points have passed. This doesn't mean you can't invest in something that's already appreciated, but it means you need to adjust your expectations and your position size accordingly. Mistake 7, neglecting the rest of your financial life. Silver is one asset class. It is not a comprehensive financial plan. Before you invest in silver, ask yourself, do I have adequate emergency reserves in cash? Am I carrying high interest debt? Am I contributing enough to retirement accounts with tax advantages? Do I have appropriate insurance? Silver cannot fix a broken financial foundation. It can only complement a solid one. We've covered substantial ground. Let's bring it together. The world is changing in ways that matter for your financial life. The unipolar moment, the era of unquestioned dollar dominance and Western-centric trade, is evolving into something more complex, more distributed, and less predictable. These transitions aren't catastrophic. They're natural. Empires rise and fall. Currencies strengthen and weaken. Trade routes shift. What feels permanent is often temporary when viewed across centuries rather than decades. Your task isn't to predict exactly how this transition unfolds. That's impossible. Your task is to position yourself so that multiple outcomes can be navigated successfully. Silver represents one component of that positioning. Not the only component, not even necessarily the most important component, but a component worth considering for reasons that have nothing to do with hype and everything to do with historical patterns, industrial fundamentals, and basic diversification principles. If you hold silver, hold it with purpose and patience. Understand why you own it. Ignore the noise. Focus on the thesis. If you're considering silver, approach it methodically. Small positions, acquired gradually, held as insurance rather than speculation. No leverage, no emotion. Just disciplined accumulation of a tangible asset that serves a specific role in your overall strategy. And if you choose not to hold silver, that's equally valid, provided you've genuinely examined the arguments and decided they don't apply to your situation. There's no single correct answer. There's only the answer that makes sense for your circumstances, your timeline, and your risk tolerance. What matters most isn't whether you own silver. What matters is whether you're thinking clearly about the changing landscape, whether you're diversifying thoughtfully, and whether you're making decisions from a place of analysis rather than fear. The multipolar world isn't arriving suddenly, it's emerging gradually. You have time to think, time to prepare, time to position yourself intelligently. Use that time well. Don't wait for certainty. It never arrives before major transitions. But don't act from panic either. Act from considered judgment, from patience, from the understanding that wealth is preserved not by perfect timing, but by sound principles consistently applied. The institutions that endure across generations, do so not because they gamble on perfect foresight. They endure because they diversify across assets, across geographies, across scenarios. They prepare for what might happen while remaining grounded in what is happening. You can do the same. Silver is being accumulated quietly by those who take the long view. Whether you join that accumulation is your decision, but make it a decision, not a reaction, not an emotional response to headlines, but a thoughtful choice integrated into a broader financial strategy. The world is changing. Your wealth strategy should acknowledge that change without obsessing over it. Balance, diversification, discipline, patience. These principles apply regardless of which assets you hold or which scenarios ultimately unfold. Start where you are. Use what you have. Do what you can. And remember, the goal isn't to predict the future perfectly. The goal is to be reasonably prepared for multiple possible futures. That's not just good investing, that's wisdom. Thank you for your attention. Think carefully, act deliberately, and may your financial decisions reflect not the anxieties of the moment, but the clarity that comes from considered thought.